Hi everybody, Jeff Yasteen here. Cannabis stocks are following a well-worn path these days. You have a certain group of companies that become fashionable to own. So investors pile in, the stocks move wildly higher, and then soon enough the party ends for one reason or another. Short sellers pile in, aiming to profit from the downturn in prices, and the stocks, they drift lower, rotting away like a forgotten platter of cold cuts. I've seen this sort of thing happen many times, both as an investor and also as an observer, as a former financial journalist who used to report on these sorts of things a lot. And I've seen it happen from biotechs to bagel chains and from dot-coms to 3D printer makers. This path of boom and bust is well known. Now, it's not hard to spot the wreckage that exists in the cannabis sector these days. You have specialty funds like the Cambria Cannabis ETF, they're down 40% since last summer. Once popular, money-losing momentum plays like Canopy Growth dropped 60% over the past year. But there are always a few profitable gems that are tossed away with the rest of the trash. And I've made calls like this before. For instance, with GE, I called that one at the beginning of last year, and the stock's up more than 50% since then. And that's where the opportunity lies these days with cannabis stocks. I expect innovative industrial partners, the symbol is IIPR, to more than double over the coming year. Say for the stock's sub $1 billion market cap, it has all the features of the companies that I recommend in my newsletter, Total Wealth Insider, on a regular basis. It's been tossed aside by investors. It's down 40% over the last 7 months. Yet, as a real estate investment trust that buys grow farms and warehouses and then leases them back to the operators, it's consistently profitable, generates lots of cash, and pays out a portion of that cash as a 3.7% dividend to shareholders. So what's not to like about that? Also, what's not to like is a company that's going to report profits of roughly $1.68 a share when it closes the books on its 2019 or reports those numbers for 2019 in early March. And that's despite the carnage in the sector elsewhere. So while other investors are waiting out the damage, Innovative Industrial Partners is using the downturn to go on a buying spree. It's been on a buying spree for most of the past 12 months, deploying more than $380 million for investments and also improvements to its properties. But cutting to the chase here, I think that shares of Innovative Industrial Partners are likely to double in price over the coming year. And cutting to the chase, here's why. Right now, investors are assigning a PE value, a price to earnings ratio value of roughly 44, looking back at what the company has likely earned for its 2019 fiscal year, which is $1.68 a share. Now, over the coming year, over 2020, analysts expect the company to earn $4.04 a share over that coming year. So if we take that $4.04 per share and multiply it by the PE ratio of 44, we get a stock price this time a year from now of $177 a share. That is where I think Innovative Industrial Partner shares will be. Check back with me as the year goes on. We'll see how this prediction turns out. If you like what I'm talking about, make sure to follow me on YouTube and on social media, as well as on banyanhill.com. I'm Jeff Yasteen, wishing you the best of good buys.